And I want you to think about each week before the new trading week begins, preferably on the weekend, okay? The idea is you want to try to get a read on what you think that next weekly candle is going to do. Is it going to go higher or is it going to go lower? You're not trying to predict the close of the weekly candle. That's important, okay? You just want to see, before this weekly candle opened up, all we had was this indecisive candle, okay? Do you think that this candle that would have formed and opened here is more likely to go higher or lower? Obviously, with the benefit of hindsight here, but I can tell you, all of my students know we've been looking for lower prices, and I'll just give you a quick short list as the reasons why. Number one, seasonality. Okay, seasonal tendencies, it tends to go down around this time anyway. We also have discussions about how the Fed's going to raise interest rates. Stock market does not like that. We're also in earnings season. There's a lot of volatility because of earnings, and those factors plus the underlying tone of the marketplace, which I'll show you when we get into the daily chart, it just, well, it's heavy, and this is where it was going to draw to, okay? Did I expect this entire range to be delivered in 1 week? No, that's not important. The point is I'm expecting the weekly candle to expand on the lower end, okay, or go down and gravitate towards this low, which it hasn't broken yet, but I think that's what we're probably going to aim for on Sunday's opening going into Monday's trading. In the early stages of your development, you want to at least try to focus your attention on where that weekly candle is going to do. Now, here's the thing. It may start the first half of the week, or maybe just one day, expand lower. And if you get a setup in that, that's it. You're done. So the only thing you're looking for is a likely movement higher or lower based on the weekly candle. Okay, that's all you're doing. That sets your initial bias for the week. On the daily chart, you're looking for swing highs and swing lows to get your liquidity, and majority of your trading and the draw on liquidity, what makes the market go higher or lower, it's predominantly found on this time frame. Okay, so majority of your analysis should really be linked to this time frame right here. You have to have an assumption whether you're going to be expecting that weekly candle to expand higher or lower. That's your weekly bias. But then you have to go into the daily chart and figure out basically where you are in the grand scheme of things on that weekly range expanding higher or lower. Because we're looking for lower prices and we're looking for weakness, the expectation is we want to see every short-term low, like this would be a short-term low, this will be a short-term low, and underneath those lows is going to be sell stops. Okay, that's liquidity. When I say learn to start looking for where the market's going to draw to, it's drawing to one of two things, okay? It's drawing to stops, which is liquidity, or it's running to an imbalance. Now, what's that mean? Above old highs, buy stops. Below old lows, sell stops. Imbalances is something like this over here, where you have one single candle pass higher, and the previous candle's high is here, and the next candle's low is here. So it only went up one candle, nothing moved down to overlap with that same delivery on that price candle there. So in other words, that's an imbalance. It's only going higher and nothing else is here to offset that and efficiently deliver price on the opposite end. So we're looking for lower prices. We're looking for an expansion. I'm using the benefit of hindsight, but I can promise you again, this was discussed. We were looking for lower prices in my paid group. And if I did not say that, I have a lot of students that are making YouTube channels. They are welcome to come out and say I'm a liar. So we're looking at the daily chart. We're going to drop down into the hourly chart. Okay, now what I have here is a framework for looking at the weekly range on an hourly chart. So all I did was beginning on midnight New York time, Monday's candle, and then Friday's close, and then the beginning of Friday's trading at midnight. Okay. Now, what I'm delineating here is the fact that we had a nice sell-off on Thursday, and the market went into consolidation overnight. Notice what happens here on Friday. This is that old low in the daily chart. That's what we're thinking or assuming that it's going to draw to, because that daily chart, there's lots of liquidity. And large fund traders, large institutional traders, institutional mindset investors will be looking at these old lows and old highs. And liquidity providers will be looking to take business in around these same levels. So if we know that this level down here is the old daily low, and again, I'm going to take it back up to the chart on the daily chart. That's this low right here, okay? By dropping down into the hourly chart, that level is here. All I'm doing is transposing those daily levels right to this hourly chart. The entire week has been bearish. Okay, it's been going lower since the beginning. Then we had consolidation in here. The market creates this short-term high and this short-term low. What rests above that short-term high? If you've taken notes and been paying attention, it's buy stops. What's resting below this low here? Sell stops. Watch closely. The market trades down initially and takes out the sell stops. Why would it do that first? This is inducing shorts. Okay, so it engineers liquidity. Even if the idea is that they want to take the market down to this level, if it's been consolidating, I like to see them do this type of move here, where it drops down first. It's kind of like a sucker play. Anybody that has a sell stop below here, they want to sell on weakness, they're going to get tripped into the marketplace. So now they're triggered in short. And then they start doing a run against those traders and against those that were already short from this high. So what are they doing? The market's being driven higher, and the algorithms are going to attack that buy stop liquidity pool. Why would they want to do that? Number one, it's going to punish those individuals here that went short. When it drives above this high here, it sends all those buy stops into market orders, flooding the marketplace. That gives a huge influx of willing buyers at a high price, which is the perfect counterparty to smart money that wants to sell at a high price. Remember, the market wants to go down here. So when it drives up to here, those buy stops are the counterparty or the other side of a smart money trader that's wanting to go short, because they're going to sell short. They got to sell it to somebody who wants to buy it at a high price. That's why the market does this. Okay. In your notes, you want to record anytime a significant price move lower is expected, always anticipate some measure of a stop hunt on buy stops or a short-term high being taken out. Obviously, it's reversed when you're looking for higher prices. Generally, you'll see a short-term low taken out and sell stops taken before you see a very pronounced rally higher. Don't take my word for it. Go through to your charts and you'll see it's actually occurring almost on a daily basis. So we're going to drop down into a 15-minute time frame. So that same old low level down here, and that high I just mentioned on the hourly chart and the low on the hourly chart is now been defined with a small little line segment. Okay, so we have a trend line here and a trend line here. That's the extent of a trend line. That's it. I only use them to highlight to my students. These levels are not on my chart. I'm watching a naked chart. Okay. You, while you're developing, you should have these levels drawn out on your chart because it helps you build and ingrain the idea that this is where liquidity is. It keeps you focused on that because it's easy to look at all these candles forming if you have the luxury of watching it in live, and you can lose sight of where you are. I mean, once you lose your bearings, it's really confusing. And this helps you keep those bearings in mind. And what do I mean by that? Well, I mentioned how the market dropped down initially, and that takes the sell stops out. So sell side liquidity has been attacked. Traders are now tripped in going short if they sold on a break, trying to be a breakout artist. And then the algorithms go right back up to an area where it's been cleanly delivered relative equal highs. See how this high here, right before it dropped, is basically the same high here. Notice that? So retail traders see this and they trust it as what? Resistance. So the books always say, put your buy stop, if you're going to go short, right above a clear level of resistance. Well, these levels work for a short period of time, but majority of the time you see this event right here. And this is how I teach my students to go in there and look for those types of events, because what did I just tell you moments ago about looking for significant price moves? Before there's a significant price move of any real magnitude or importance, generally there's going to be a stop hunt that takes place right before that price delivery occurs. So what does it look like? You have relative equal highs, this high and this high. The market goes up when we're what? We're expecting lower prices on that weekly chart. We're on the last day of the week. It's already been heavy. It's weak. And the only thing it's been doing is consolidate. And the first thing it did was broke out to the downside, tripping what? Traders in a breakout to go short. So now they have traders caught on the wrong side, offside, and now they want to take the market up here, where those buy stops are going to be resting for those that were smart enough to sell short here or here and didn't get out below here. So the larger pool of liquidity is going to be resting here because it's in sync with the downtrend, and everybody that was short the day before, they seen this high form, and once it broke below this low here, they all rushed and trailed their stop loss right above that. But this pool of liquidity, once this occurs, you want to drop down to your lower time frames and start looking for something specific. And let's go into those lower time frames and find out what that is. Okay, here's a 2-minute chart. Why a 2-minute chart? Well, 2 minute, 1 minute, or 3 minute, or 5. 5 minutes still has a lot of room for imbalances to occur underneath that time frame. And what do I mean by that? The 1 minute, 2 minute, 3 minute chart tends to be the best for finding the imbalances for indices. Okay, don't take my word for that. Okay, if you're looking for high frequency setups intraday, the 1, 2, or 3 minute chart are just beautiful. They just offer a real good clarity. The reason why, because the high frequency trading algorithms are operating on nothing really higher than 3 minutes. But majority of the time, they're like seconds. Okay, 15 second, 30 second, 45 second, 60 second intervals. Okay, and what they're looking for are these small little imbalances. And what does that look like? Well, we have that run on the buy stops here. Okay, remember that old high here, the old high here, old high here. It runs right on through that. Once this occurs on that higher time frame, 15-minute time frame, you want to drop down to the lower time frames. And I'm using the 2-minute chart because this is exactly what I was using to find that imbalance and trade off of it. Okay. The market creates a short-term low here, and then it breaks below that. This is key. This is called a break in market structure. Now, the foundations and underlying framework is we're in a market that's what? Weekly bearish. We're expecting that weekly candle to expand lower. It's been expanding all week. So we have momentum on our side. We have a consolidation that's occurred, and we had a pool of liquidity engineered with these relative equal highs, and the market broke out to the downside first, and then they ran on the highs. So once it went here, we don't rush in there and just go short because it went above the old highs. We're looking for some specific signature that tips its hand to you, okay? And I promise you, when you start going through your charts, and it's going to be homework for you, you're going to see this occurring almost every single day. And if it's not doing it this way, it's doing it the opposite direction as a buy, okay? Again, don't take my word for it. You're going to be flabbergasted. You like that? Flabbergasted when you see how many times this thing forms every single week, okay? It's many times throughout the intraday charts it creates this type of move. But it runs the stops, then we have a short-term low, and then it breaks below it. So now we have a break in market structure, okay? Once this low is broken, you're going to look for this little area here. That's that imbalance I mentioned in the beginning, right? So what's happening is the market's going to go right up inside that area there, and that's where you want to sell. The idea is once it go up into that imbalance there, and once it does that, as soon as it enters that area, the algorithm that delivers price. Now, some of you may not know what that means, and some of you may not even agree with it. You may think that this is made up or it's contrived. I promise you, if you spend time with this, you're going to quickly come to the conclusion that there absolutely is an algorithm, and it's manipulating the markets every single day, every single tick. It's completely controlled, okay, period. You're led to believe it's buying and selling pressure. Now, if I go back and use that analogy where it went down here first, then go up here, some of you may argue, see, that's the buying and selling pressure. No, it's not. It's liquidity. Now, you may argue and say, well, we're arguing semantics. No, I'm telling you what's going on. This is the logic. This is how these markets book. But focus on the imbalance after the market structure breaks. So this big candle here, it breaks down. Look at the next candle. It opens and trades higher and stops right there. So from this candle's low and this candle's high, when this candle starts trading, As soon as it opens and it runs right up into that, that's a short. You can go right in there, sell short, be done. Now, where's your stop going to be? Well, you can put it above this high here, or you can put it above this candle's high, whichever your risk parameters allow for. Okay. If you're trading the micro, which is, again, it's not a lot of money per tick, so the multiplier for that is very, very small. Looking at this further, we're going to look at the logic in here, and I want you to think about after this forms and you see that as your choice setup or entry. If it starts to move lower, you can still get in it. There's no reason not to think that you can't get in it here or in here. It's close to or in close proximity to where that area is as an entry. Once we take out a low, though, once that occurs, then it becomes a matter of your chasing price. And if you try to get in, especially if you like use a market order, you may see it trade right to this low and say, okay, now I believe it's going to go down. You put a market order and sell short, and then slippage gets you down here. And that creates a larger area of risk that you have to assume, and it's problematic. You want to learn to trust going short when the market's going higher, and that feels scary at first. But once you start seeing this pattern form, it becomes easy to trust it. And in fact, you want to be doing that. You want to be selling short, expecting lower prices right when the candle's going up.